Why pay more for your precious metals from the big guys with offices on Wall Street and who bank with JP Morgan? From the basics like eagles, maples, rounds, and bars, to collector coins like the Silver Shield and Heroes SD War Collection, to our exclusive line of insurance-approved, TL-rated precious metal safes, SD Bullion has what you're looking for at the lowest prices, period. Guaranteed. Find out why over 15,000 new customers have recently made the switch to buying their gold and silver from the dock. Give our team an opportunity to earn your business today at SD Bullion. Why pay more?
This is the Doc and Eric Dubin with the SD Weekly Metals and Markets Wrap. With gold and silver hammered the second half of this week, we thought what better time to bring in one of our favorite experts in the space across the pond, Alasdair Macleod. It's great to have you back.
It's nice to be back.
Well, let's get right into the price action this week. On the heels of the Federal Reserve's FOMC statement on Wednesday, gold and silver were both smashed back below their respective 200-day moving averages. To my eye, it looks like the goal right now in gold is to push it back down to around 1110 and see if they can break the stops there. Silver, right now it's clinging to 1560 level, which is a pretty important technical level. What's your take here, Alasdair, on the trading action in gold and silver here the second half of this week?
Well, it's very much in the future, in the futures market, not in the physical market. I think earlier on Wednesday morning there was some buying of the physical, and the time it occurred really was when it was daylight in the Middle East. So it was really before the Europeans started trading, and they would usually deal in physical over there, and it really meant that the gold price was very strong until the FOMC statement was released, and then it was sold off. And of course, at that time, it was around about midnight in Saudi, or in the Gulf states. So the physical buyers were basically out of it at that stage, which of course allows the commercials and particularly the bullion banks and the swaps, who have become quite short of metals in the futures, it allowed them to basically knock it. And I think that's really what we have seen. Whether there was collusion between them and the Fed or whatever, I don't think so. I think it's they just happened to interpret the Fed in a way which allowed them to knock the price. So it's, in a sense, it's a bit of a non-event, and I know that the technical boys will run around and say that there's whether it's in a bull trend or bear trend or whatever. But actually, if you look at it from a sort of standing back point of view, gold is, I think, pretty well as cheap as it's ever been. I've calculated relative to the amount of what I call the fiat money quantity. If you price gold in 1934 dollars, currently is at $3.43. The lowest it has been since 1934 in 1934 dollars was $3.13, and that was in April 1971, which was just 4 months before Nixon threw in the towel and couldn't suppress the gold price anymore. So we're in the same sort of value territory as we had then, which is an interesting thought.
And as you mentioned about taking a step back, if we take a step back and put it in perspective about the downside risk in gold and silver versus the overall market, let's say, what's your take on that, Alasdair? I mean, my personal opinion would be in gold you're looking at a possible, outside of an entire derivatives event where the entire financial system goes under, my personal opinion would be that the downside risk in gold is somewhere between 900 and 1,000. So on a percentage basis, you're not very far from that versus the overall market after the run we've had for the past few years.
Well, yeah, you've got the large firms, the people like HSBC and Goldman Sachs and all the rest of it. They're still trying to talk it down to $900, and I just sort of, again, I stand back from it and I say, what's their interest? Well, basically they're short and they would like to buy some. So, if I was in their position, I would probably talk it down as well. So I don't think it really means anything. I think coming back to your first point, as to whether it is cheap relative to equities and so on, equities are overvalued. You've got a global economy which is faltering actually very badly, and the only valuation that equities will look at is, interest rates are at zero and perhaps they'll go negative, which incidentally is not the story that the Fed wants to push out. But there is no doubt that with no earnings growth coming through, other than earnings growth through financial engineering, in other words, borrowing money to buy back stock and to reduce the amount of outstanding shares. Other than that, I just see equities as being really pretty fully valued, and I think I'm being kind in saying that. Whereas when I look at gold, again, I repeat that in 1934 dollars, we are at a tenth of where it was. We're at $3.43 in 1934 dollars, and we are at the same point pretty well where we were in April 1971, which was 4 months before the whole thing took off. Nixon had to give up on the whole of the Bretton Woods thing with the Nixon shock, turned around and said, we're not going to give in to speculators and all that sort of stuff, which was, we know, is the sort of thing that politicians say under those circumstances, because he was defeated. And I just see this similar conditions for gold. I mean, don't ask me when it's going to move. Don't ask me whether it's going to go down to 900 before it goes to 1300. I haven't a clue. None of us have a clue. But what I do know is that on a value basis, it is absolutely horrendously undervalued.
Sticking with the theme of trying to put a big picture perspective on all of this, I mean, markets revert to mean reversion. We've been through a 4+ year period where silver's been in a bear market and gold almost as long, and meanwhile the equity markets have been shooting higher for the most part, and for the better part of the years between the 2008 crash and today, we actually had a 45-degree angle line on the S&P 500 chart. I mean, it was so consistent and so handmaiden, shepherded by the powers that be, that the stock market now is in a very high valuation territory relative to the prospects of earnings falling off as the economy slows down worldwide and interest rates move back up. So markets go through cycles, and we're way due for a very large move in precious metals over the next 18 months or something like that, because the history shows that those are the time frames by which cycles tend to turn. And it's very interesting too when we look at this year overall. I mean, we had made a very big point of spotlighting silver as being the Achilles heel to the precious metal space because of the market being so much more tighter, and how during the course of this year it really didn't seem like the cartel was going to be able to get prices below 15. Well, they were able to get it below 15 for about roughly 2 months or so on average, with a one-day spike below 14. But all things considered, the market is exhibiting the signs that we would want to see that suggest that it's very tight. And silver has been responding faster than gold in the month of October. I mean, it shot up in the first 4 days of trading and basically has gone, for the most part, horizontal, hugging that 200-day moving average, as opposed to gold going up for the first half of October and then the cartel making a really aggressive effort to push it back down again. Because, again, as we pointed out 2 and 3 weeks ago on our show, that this 200-day moving average is a trigger for a lot of managed money that follows charts and technical analysis. And even though a lot of people in the precious metal space, particularly the stacker community, don't like technical analysis, a whole heck of a lot of managed money around the world, the majority of paper pushing trading in the precious metal space, in fact, is governed by technical analysis and perspectives like that. So it's encouraging to see silver be strong as it is now, and popping over the 200-day moving average, and all of this as well coming on the heels of the Fed and more aggressive jawboning speaks volumes. I mean, the earnings are declining and the economy's rolling over, and the dollar remains strong and has a tendency of moving stronger because of the cleanish shirt in the dirty laundry pile phenomenon worldwide. So the Fed's basically stuck, and the biggest and most frequent tool that they use is jawboning.
Yeah, Yeah, no, I would agree with that. And in fact, if you look at the FOMC statement, that's basically what it was. It was no more than that. So I would agree with you.
The last time around, they were more inclined to signal that they were not going to raise interest rates this year. And I think that was a product of coming on the decline in the equity markets through July and August. And now that we've had this bounce back, they're being a little bit braver with their jawboning. But that really is all that it is. It's just propaganda.
Yes, I would agree with that analysis entirely. I mean, the S&P has risen roughly 10% from the end September low, and I should think at the in the Fed they were probably breathing a sigh of relief. But this isn't over. I mean, one thing that's interesting is if you look at it from the Chinese point of view. If the Fed is now sort of talking about, we're not going to reduce interest rates anymore, it's just a question of when we raise them, the Chinese could stop that any moment, which is actually what they did back in August, because we read what they're doing with the currency as devaluing, but actually what they're doing, if you look at the amount of trade that goes on in the internal Chinese economy, they are actually bigger than the US. I mean, there's a fascinating statistic that came out. Alipay, which is Alibaba's payment system, in one day handled more than the whole of US retail business, both online and in bricks and mortar, over a 3-day holiday.
And
China did it one day.
Alibaba's been running like 30% above year-over-year performance overall for the whole year.
I mean, and that's just one system, Eric, in China. So if you bear that in mind, then actually, if the Chinese change the exchange rate between the dollar and the yuan, actually what they're doing is they're moving the dollar. They're not moving the yuan. Does that make sense? Do you see what I mean? This is a point which is not understood in the West, because we find one of our blind spots, I think, is looking at it from someone else's point of view. As far as China is concerned, it doesn't make any difference at all whether they move the yuan dollar rate down, up, sideways, or whatever. But what it does do is it really upsets the Fed. And you've got to bear in mind that as far as the Chinese are concerned, and also as far as the Americans are concerned, we're in a financial war. This is not, we don't send military off to China anymore or do anything like that. I mean, we may send some ships to have a look at these islands. And what do the Chinese do? They just turn their backs and ignore them. And then you maybe have some sort of riposte, if you like, in the financial markets. That is the world we live in. And it's actually quite interesting because the Chinese will indulge in these antics, which actually means that they can effectively set US interest rates, not the Fed. The Chinese are doing it. But they're doing it in such a quiet manner that we're not aware that they're actually doing it. It's actually a very, very clever thing. It's typically Chinese.
Very apropos to their typical strategy.
Alasdair, I want to ask you a question. I know we've been discussing that it's really just jawboning, the whole discussion about raising interest rates. But anytime the Fed speak comes out that we're going to raise interest rates soon, or any indications that they will be, the algos hammer commodities, they hammer gold and silver down. But I thought I'd ask you a question. If they actually did raise rates, and I think we can all agree it's unlikely and it wouldn't be too meaningful, but if they did raise rates, could the argument be made that after an initial hammering of gold and silver, you would actually ignite a fairly strong bull rally, because potentially you would be having all of the paper that the banks have been just sitting on their balance sheets for the last 7 or 8 years. They're now being forced to lend out, which could stoke some commodity and price inflation, because it's no longer just sitting parked on the balance sheets of the banks. What's your take on that, Alasdair?
Okay, there are two questions there. I think the first thing is if they raised rates, what would happen is that it would contract bank credit. It wouldn't increase it. The reason for that is you have to think that with the current 0.25%, the banks have $2.6 trillion of reserves sitting on the Fed's balance sheet. If you raise rates, because they get paid, that's the Fed funds rate, they get paid on that. If the Fed raised rates, then it is likely that they would just attract more money out of the banking system onto its own balance sheet. And this is why they can't actually raise rates. This is why they're so frustrated. They've got themselves trapped at the zero bound. So anyway, that is the interest rate situation as it stands. The other question that you raised is what happens if interest rates are rising to the price of gold and silver? The answer is that it is likely to be very good for the price of gold and silver. Now, the reason for this is that the conditions under which interest rates would be raised by the Fed would be reluctantly to take account or to counteract a falling purchasing power of the dollar. In other words, if you look at the purchasing power the other way, price inflation. If the price of goods and services starts rising, particularly up towards the 2% and then beyond the 2% threshold, which the Fed has set, they're going to have to start raising interest rates. But what they will do is they will always lag behind the curve. And the reason for this is very simple. If they raise interest rates by enough to try and control inflation, then they're going to bankrupt the US government. They're going to bankrupt a lot of business, which basically is just trying to survive and roll over its debt. And they would also probably bankrupt a number of banks who are on the wrong side of derivative bets, where what they've basically done is they have bought floating rates and sold fixed rates. So there are a number of things that are likely to happen, which I would suggest are very, very good for gold. Now, that's a very different analysis, perhaps, from what people would actually think. But if you go back and look to the 1970s, which I lived through as a stockbroker, what happened then was that interest rates rose over the decade, and they rose to really quite high levels. Gold peaked in, I think it was 1980 or 1981. Now, the reason it peaked was that Volcker came along, and what he did was he actually raised interest rates to the point where it killed inflation. And really what that meant was that he raised rates above where they would naturally be in the economy, and by quite a significant margin. And as a result, he bankrupted the whole of the savings and loans industry. So, he actually took the bull by the horns and said, right, this has got to stop. Now, can you imagine that happening today? I cannot. We already have my favorite measure, the fiat money quantity, in hyperinflation. What that means is that the amount of, it's the sum total of what the Austrian economists call true money supply, plus the banking reserves on the Fed's balance sheet, plus a few other adjustments which you have to include to make that a true figure. That is in hyperinflation. It has jumped in the last month from under 14 trillion to well over $14 trillion. It is now about $5 trillion above the long-term trend that was established up until really 2008 when we had the banking crisis. Of course, after that it took off. You can see that of just looking at the Fed's balance sheet, it took off. It took off basically because the Fed produced an awful lot of money to buy rubbish debt, particularly Fannie and Freddie stuff, and which they value at par still, by the way. The result of all that is that you have a hyperinflation of the fiat money quantity, and sooner or later that is going to work through into prices. It's got to. It won't work through in the way in which the Fed anticipates. What the Fed anticipates is that eventually the economy will take up some of this money and begin to use it and grow and all the rest of it. No, what will happen is that prices will start rising, measured in dollars. In other words, the purchasing power of the dollar will fall, and the reason for that is quite simply people will begin to understand that the purchasing power of the dollar is too high, and they will change their preferences away from dollars into goods and services. Now, normally when people do that, it's one or two of us, and there's always someone going the other way, so there's a balance. But when you get the crowd shifting their money preferences, then you get what could lead to a collapse in the purchasing power of the currency. And that I fully expect to happen within the next 2 or 3 years. Or if not actually to happen, to be a big, big danger. And then we've got the problem. I mean, what do we do? Call on Mr. Volcker again and say, why don't you bankrupt the whole of America this time with higher interest rates? At least we won't have hyperinflation. So, I mean, it is a very difficult situation. And I think part of the problem I think the Fed faces is they just know there's something wrong with a situation where the economy doesn't go anywhere with zero interest rates. They're looking at Japan and seeing what happens there. And I think that anyone with any sense, and I'm not talking about the sort of the Keynesians, the wilder Keynesians, but anyone who's got any sort of common sense when it comes to economics would know that they've got themselves into a trap. And the trap is getting more and more difficult to escape, partly because there is absolutely no control over the fiscal situation. The government is continuing to run a deficit. If the economy starts sliding down, that deficit is going to get a lot worse. It's a very precarious situation. So it's not good.
A lot of people always point to the bank balance sheet phenomenon, and money is stored at the Fed, and saying, hey, well, we're not going to have inflation because it's just going to stay there. That's not possible. Historically, what we've seen in the last 7-8 years is pretty a deviation from what we normally would see in history. And at some point, that dry powder, that kindling of inflation is going to come out of the banking system and into the real economy. And per Austrian school, we already have seen the first part of the inflation in the financial markets. I mean, the record levels of bond pricing and low yields that we have been moving through is like 400-year level historical aberrations. The markets have been manipulated to the point of insanity. And whether or not we have visible inflation that's registering in the government statistical fantasy machines of unicorn meat and blowing rainbows, the reality is that we can see inflation in the financial markets, and we've created this kind of crazy monster in the financial markets such that at some point it will probably fall apart, and the Fed and other central banks will have to respond with even more liquidity. And that's when the confidence game is going to be up. I think that 2016 is going to see that inflection point, because the duration by which the Fed and other central bankers have been able to maintain this charade has been just astounding, and I don't think it can go on much longer. And that's what we see with both in FX and equity market volatility, signaling that kind of beginning shift. I mean, when technically speaking, we see a lot of volatility in markets, it usually is presaging some kind of a big move.
Yes, I think that's right. I'd just like to go back on one thing, and there is this sort of belief, certainly amongst the macroeconomic community, if I can call it that way, that the relationship that matters is the quantity of money. And that is the only thing that really affects prices. There is something that the macroeconomists cannot explain, and that is there is a delay very often between the production of money, new money that is, and the effect on prices.
And that's the velocity analysis.
Well, you see, this is it. All velocity is it's a balancing figure which has got to go into the equation, the monetarist's equation, the exchange identity, in order to make it balance. Otherwise, it wouldn't balance. But that's all it is. I mean, any fool can make an equation balance just by pulling in a variable which will adjust to make sure it balances. That is all that is. I mean, this whole concept of velocity, I keep on telling people, is a load of rubbish, actually. What really matters is not the quantity theory of money. I don't deny that an increase in the quantity of money is, over a period of time, going to lead to a lower purchasing power of that currency. I mean, that we can all accept. But the variable that really is far more important than that is whether people actually prefer to hold more currency relative to goods or less currency relative to goods. Now, as I said earlier, when under normal circumstances, you find that some of us like to hold a bit more, some of us like to hold a bit less, and it all sort of more or less balances out. But when you get a scare developing about the purchasing power of the currency, if it gets to the state where nobody wants the currency, if nobody wants it, it's valueless, completely valueless. So we go somewhere between the equilibrium we have at the moment towards a point where it is valueless. Now, under those circumstances, you find that mysteriously prices start rocketing through the roof, and there is no real explanation for it. And I'm sure that you got the Venezuelans and all the rest of it sitting there thinking, we don't understand this. This is just complete nonsense. Surely we can control these prices. No, you can't. Prices are entirely subjective. And the only reason that we accept dollars as money is because we believe that they work as money. If you shake that belief or threaten that belief, then suddenly you're going to find that people are not going to want to hold it. And they would far rather buy things they don't need on the basis they might need them tomorrow, or even buy them on the basis that they might be able to sell it at a high price tomorrow. And this is actually what happens in every hyperinflation. You can have long periods of time when you increase the quantity of money and it has very, very little effect on prices, or at least on the prices that you're studying. It may have, as you rightly pointed out, Eric, in this case, it has actually had an effect on asset prices rather than the prices of goods and services. But there will come a point where people begin to wake up to what's actually happening to their money. And when they do wake up and they change their preferences, then you can have as many dollars as you want for nothing. And this is the mystery that the macroeconomic community just do not understand. They haven't grasped it. It is an insight that Carl Menger had, and of course none of them have read Carl Menger. So that's basically it.
Yeah, and it's interesting too when you think about the whole span of the last 100 years plus of the Federal Reserve history. I mean, the whole mission about it, guaranteeing price stability and market stability and all that other nonsense. I mean, now that we are no longer on a gold standard and that worldwide or vast majority of commerce is conducted on a fiat basis system and debt is going berserk, we keep having these market crashes and then reflation cycles, and each time they get bigger and bigger in terms of the amount of debt that goes behind the system to keep it afloat. And the ironic thing about the Keynesians is that when they look at financial market appreciation and fail to recognize the risks that come with financial market inflation, they just don't understand, or rather choose to ignore, I think better said, that this bubble cycle, flywheel that we've been on consistently since, nothing new with market crashes, but they're just getting bigger and bigger every time we go through these reflation cycles. And the happy talk about, well, inflation is not present in the system is really an illusion, because even if inflation weren't to push prices up further in the real economy, the financial markets are so unstable at this time that they're going to create a crash that will ultimately require QE to infinity, so to speak. And that's really going to be the change that shifts the conventional financial world managed money thinking, I suspect. And we're not too far away from that.
I think I would agree. I think your remark, QE to infinity, there's another way of putting it, and that is negative interest rates. I don't know if you're aware of this, but more than half the European bond markets, their 2-year government notes are now yielding negative interest rates.
Right.
I mean, this is the ultimate distortion in markets. It's just absolutely crazy. To give the listeners an idea as to how stupid this is, can you imagine deciding that you want to lease a bit of equipment? Let's say you want to lease a bulldozer, so that just for a sort of a week, hire a bulldozer for a week, so that you can maybe rearrange the landscape in your garden. You turn up at the hire shop and say, "I want this little Japanese bulldozer thing. What's it going to cost?" They say, "It'll cost you nothing. In fact, we will have to pay you to take it away and hire it. How about that?" That's actually negative interest rates. I mean, it is completely nonsensical. It is nothing to do with how humans work at all. It is a construct of macroeconomists who are just have got no idea at all about the purpose of interest rates.
And what happens when that goes into effect? Suddenly you have 100,000 new landscapers in the city.
Well, you could do. Okay, I just use that as an example. I mean, another way to look at it is to say to someone, look, a promise to be paid in the future is worth more than cash in the hand today. I mean, it's completely nonsensical. This is not human. It really isn't. But the interesting thing is that if you put a negative yield on cash, then immediately you throw all the commodities into backwardation by definition. So you have a situation really where I think if they did put in negative interest rates on a reserve currency as opposed to one of the smaller currencies like the Swiss franc or the Danish kroner or the Swedish kroner, then particularly something like the dollar in which commodities are priced, the effect on commodity prices could be really dramatic. Now, if the Fed really wants to kickstart what they call inflation, which I call falling purchasing power of the currency, that is a guaranteed way to do it.
Well, that raises an interesting speculation. Why do you think the Fed has not been willing to do that, in your opinion? I mean, given the failure to ignite since green shoots of Bernanke 2010, they certainly have had enough evidence to be data dependent to show that their recipe ain't working and that the soup isn't being cooked.
I think the problem is that they'd actually, I mean, everything they've tried, which should have worked, hasn't worked, and so they're actually completely lost. I think if you put yourself in their shoes, they really do have an enormous problem because, they've been taught by all these wonderful professors at Yale and all the rest of it. This is what you do. You iron out the cycle by deficit spending. Okay, they've tried all that. And what's happened? The economy is still stumbling along, being very disappointing in terms of its growth. All that's happening is that the government is borrowing more and more money or rolling up more and more debt. You can see that this is going to lead eventually to disaster. So you've got to, you're as an FOMC member, you're now in the position where you actually just don't know what to do. And I think it's the fear of that which quite sensibly, but by accident, probably discourages them from trying negative interest rates. But there's going to be an increasing clamour for it because as you get no economic recovery, as the effect of falling commodity prices continues to work through on the retail price index, or the consumer price index over there, then you're going to get, the Larry Summers of this world and the Krugmans of this world getting more and more support for their ideas that actually what you've got to do is have negative interest rates and take any limit off the creation of debt to rescue the economic situation. This is what their textbooks tell them. And, and I think, we sit here, we can say how stupid the whole idea is and all the rest of it. But when a government or when a central bank gets desperate, they do these things, I'm afraid. And I can see this in prospect. I mean, I hope it doesn't happen because I think, well, I don't know what I've given up actually thinking what I want out of this because, I mean, really what I should want as a responsible member of the global community is some sort of economic stability and financial stability. But we're not getting it, and we're certainly not getting it under current policies. And almost, one's tempted to think, well, the quicker they actually destroy the system and we can start again, particularly for someone like me who's now 67 going on 68, I'm not on this earth for a hell of a long time. I want to, I want to have a good outlook. As long as they delay things, as long as they repress things continually, it's not going to give me a good end to my life. And so to hell with that. I would actually want to do something constructive. But, this is not what politicians are elected to do. They're elected to perpetuate the status quo, and central bankers certainly are not appointed, if you like, to upset the the political scene. So it's all keep the show on the road, kick the can down the road, and old guys like me, can just take a running jump.
I remember
just retire quietly to the old folks' home and shut up.
I remember in previous crises, Robert Rubin, and I'm almost ashamed to admit I can't even remember what crisis it was. I think it was in response to a third world debt crisis. But basically, the formal policy that he articulated was to hope that within 6 months' time the markets would reestablish themselves and gain some stability, and then to extend and pretend and pray was the formal policy. And to some extent, I think that's really what's going on now at the Fed, too. And we had Nomi Prinz, for example, delivering a speech a couple months back at the New York Fed, and her impression, based on all of the New York Fed voting members there and whatnot, I mean, Yellen wasn't there, but a lot of the FOMC members were there, and many rank-and-file economists within the New York Fed, and she basically said that they just don't know what the heck's going on, and they're buying time in hopes that the natural healing process of markets actually do the work for them.
I'm sure that's right. Sorry, I interrupted. I'm sure that's right.
They just don't have a clue. I mean, they're hoping that the natural rhythms of the economy and the markets will reassert themselves. And that's really the bottom line philosophy and modus operandi of the Fed right now. That and the job money.
Yeah, absolutely. Oh dear, it's all very depressing. Anyway.
Yeah.
Perhaps we can find something more cheerful to talk about. But
well, yeah. I mean, we haven't even hit geopolitics yet. I mean, come on.
I try and stay off politics because my take on sort of politics is that if you express an opinion, basically you got 50% of people are Democrats and 50% are Republicans. If I can talk in your sense, over here it's Labour and Conservative. So if you express a political opinion, you just upset half your audience. So I try and avoid talking politics. I just try and talk sound money. But of course, the politicians won't listen to that of any creed.
Yeah, and I think there is one unifying theme in that the level of insanity is on the rise. Geopolitics war is definitely going to heat up and has been heating up all year. And as the world economy turns down and as issues with our economy continue to struggle, very often, as Gerald Celente likes to say, when all else fails, they bring us to war, or they take us to war.
And I think it's rather safe to say that, Alasdair, that probably 95% of our listening audience shares the same sentiment with you, that let's just get on with it.
Well, I think so. I mean, I'm not in the unfortunate position of so much debt that I go bust in the process. There are a lot of people in that position. I don't know what it's like in America, but over here in the United Kingdom, there's a staggering number of people who have so little liquidity that when it comes to payday, they're up to their maximum on their credit lines, and they need their paycheck in order to create some room so that they can spend. I mean, there's just no savings at all. This is very, very common in sort of ordinary factory workers and the low paid and all the rest of it. It's that I think is actually a very worrying situation, because if what we're talking about actually does come to a shuddering halt, as inevitably it will, I'm afraid, those are the people who are going to get hurt, and they're going to get hurt very, very badly. And in that sense, I think the whole of the political system actually has let down the very people that it should be protecting. Or at least it should. They can't protect. I mean, part of the point is, I'm sorry, I'm getting onto a bit of a rant here. Part of the problem is that no politician is going to stand for office on the basis that people should actually take responsibility for their own actions. No, instead a politician stands and he says, "I will sort this for you. I will sort that for you. Vote for me." And the result is that everybody expects the politicians to sort things out, when actually they should be taking responsibility for their own affairs. They should be protecting themselves. This has been going on so long in this country now that people actually are so exposed to any if you like, disruption, economic disruption, that it's very, very painful. And of course, this makes it even worse for the politicians. It makes it even harder for them to envisage taking sensible action.
All right. Well, I think that's probably a good place to wrap up the show this week.
Before I rant even more.
Before our editor says none of us are invited back on next week's show.
Well, it'll be my fault. You can blame me.
Well, it's always a pleasure, Alasdair. Certainly is one of our favorite guests for sure.
Well, it's very much my pleasure. Thank you very much for having me on.
And before we let you go, if you can let the listeners know where they can find your regular weekly work.
Yeah, I'm head of research for Gold Money, so you'll find that on our site. We've revamped the site, actually, since we were taken over by BitGold, which is really going quite well. I mean, there's a lot of interest in that one. And I also have my own site, which is financeandeconomics.org, O-R-G, which basically repeats what I do on the Gold Money site, but it is dedicated to my work, so you might find that more convenient if you can't be bothered to read the other stuff on our site, which, of course, is all very, very good and very interesting anyway.
Hey, before you go, too, has there been geographic patterns of interest with BitGold's market penetration, say, for example, with people in Asia? How is that comparing to North American consumer response to the service?
I don't know the details on that, Eric, but what I do know is that the interest is worldwide. It really is. I think the announcements that they've made so far, you're looking at adding something like 100,000 a month. I mean, it's of new accounts. And they're coming out with new features the whole time. I mean, of course, I've got an account, of course I have. And I got an email saying that, not only can I now save, so, if I can get my bank, if you like, to do a regular payment into my BitGold account, which immediately just accumulates in gold, which is super. The other thing I can do, if I was a merchant, is I could get people to pay into my BitGold account, and I can give an automatic instruction to BitGold to redeem either all of the payments coming in, or not necessarily from me, but from my customers, or a portion of the payments, like 70% or 60% or whatever, into a currency of my choice. And the thing that's important about this is that if you deal across currencies in the banking system, you get charged a lot of money. I mean, typically, the example I use is if you've got a sort of Filipino nurse, for example, as we have lots over here, they routinely send money back to their families in the Philippines. And the bank charges amount to somewhere between 6.5% and 7% of the money they send. That's a hell of a lot. And, if they have a BitGold account, it's 1%. If there's a BitGold account at the other end, it's 0 across the account. It's only 1% when it's realized at the other end. So this is a $600 billion market. And it is quite staggering. We're the only people doing it, which is fascinating. The other thing that is really fascinating about it is that we've all been brought up to understand Gresham's law, that bad money drives out the good, which is basically what's happened to gold. BitGold has sort of reversed that. I mean, people are using this for day-to-day payments. In other words, they're bringing gold back into circulation, but not through the banking system,
Yeah, and stackers tend to be skeptical of any form of paper gold, but BitGold is definitely a different animal.
There are two aspects in this, Eric. One is yes, it is gold. It's not paper deposits or anything like that. The other thing is that when you deposit money into your account, it does not appear on BitGold's balance sheet. It is yours. We act as custodians for your deposit. And that is a very, very important difference, so that you're not exposed to the risk of, BitGold's liquidity, if you like, as a business, in the way which you are with a bank. Because if a bank goes under, you whistle for your deposits. I mean, but that's not the case with Bitgold for the very simple reason that you actually own the gold. It is definitely your gold. It is defined as your gold. It is audited as your gold, and it is completely separate from Bitgold or Gold Money's own assets.
Yeah, and it's making gold more useful as a currency.
Absolutely, and I understand there's there's sort of a lot of the accounts that have been opened are in Asia. And I would personally expect that to be a real growth area. I mean, I gave you the example of the Filipino nurse. I mean, but that's the same all round Asia. Cross border payments and all the rest of it. I mean, it's got tremendous potential. I find it fascinating, and as a sound money man, I'm absolutely over the moon that somebody's actually cracked it. And I'm even more over the moon that I'm involved with it, by the way, which you would expect.
All right, well, keep up the good work, Alasdair.
We will.
All right, so I think we'll wrap up this week's show there. Again, Alasdair, pleasure to have you back. Thanks for your time.
My pleasure.
All right, for the Doc and Eric Dubin and our good friend Alasdair Macleod, thanks for tuning in to this week's SD Weekly Metals and Markets.